Hi traders, and welcome to this week's edition of the Keyzone Traders Trade of the Week. Now there's been a couple of weeks break, quite unfortunately, whilst I had a bout of illness, but I'm back and raring to go, and we got back in the saddle in the trading this week. Now it was a tricky week of trading because we had the US holiday at the start of the week, we had non-farm payrolls at the end of the week, plus we had the extended UK bank holiday towards the end of the week, which meant liquidity was a little bit drier. So we had to be extremely patient for our setups, and in fact we only got one trade this week. So it's a fairly easy decision to choose which trade to take, but it also gives us some valuable lessons around patience and waiting for the opportunities when they arise. So with that being said, let's go take a look at the charts. Okay traders, so welcome to the trade of the week for this week, and this one is an S&P trade. We took it on a higher time frames on the hourly for a reversal, and it had been an area, it was in an area that we'd been looking at for quite a while. So you notice this is our S&P 500 report from the 27th of May. This is part of our Keyzone service, a US Keyzone service, which you can sign up to. I'll leave the link in the comments box below on our YouTube channel. You can sign up to it completely free to receive these reports before the market opens. But you can see here on the 27th of May, we said that the SPX needed to clear the 4076 to 4091 area to see moves to the next resistance at 4123 to 4133. We had also been talking about it on the 30th of May, where we said that main support, you can see here we say main support was at 4076 to 91. The trade that we actually took was on the 1st of June. So we've been talking about this level at 4076 to 4091 as being a key area in the market for about a week or so. And we said that if we start to see sustained breaks below that area, then we could see moves lower. But we said it was support, and we'd spoken about that being a really key area in the market in previous reports. We said if the support zones held, we could push higher. We had resistance much higher. So now let's go and take a look at the trade that we actually took on Wednesday. Okay, so this is the hourly chart, and hopefully you can start to see why it was such a key area in the market that we've been speaking about for quite a while. We had it as act as support here, and then support again here, and then we had resistance a couple of times in this area here before holding it as resistance, and then we had another retest here right before we broke out over here. So several times that we had touched this zone and this area in the market recently, we had a reaction either as support here, we then broke through it, and actually even here we can see we actually acted, once we broke down through, we actually held it as resistance, and then we held below it, held it as resistance, held it as resistance, held it as resistance, and then broke back through it. So the majority of the time, over the last sort of 1, 2, 3, 4, 5, 6, 7, over the last 8 or 9 times that we had entered this area, at least 6 times there had been a reaction from it. 1, 2, 3, 4, 5, and 6. So 6 of the last 8 or 9 times that we'd entered this area, the market had reacted in some way. So that's meant that it was a high probability chance that coming into this area, especially since it was the first test since the breakout over here, and there was a higher probability that the market would react again. So with that being said, we had been looking at this area in the market for about a week, and we'd certainly been looking at this market as an opportunity to buy from for a couple of days. Now, with the liquidity being low, you have to exercise real patience to wait for these key areas in the market, and this was the action on Wednesday. So move forward, we then got our buy signal. Now notice again here, if we zoom in a little bit, notice that we take out the liquidity of that zone just there. We just take out the liquidity, just dip below it, grab the liquidity, take out some stops, and then put in the reversal. And we're extended into this area. So we enter a buy signal just above here. We was in at 4091 spot 5 here, and we had a stop of about 18 points there. We actually targeted 4118 on this trade, which, as you can see, is about 1.5 to 1 risk to reward. Now, what I sometimes do, especially when we see this sort of impulsive price action, I sometimes move down to lower time frames to just see if there's any danger to the trade. So as you can see, this is more of an advanced concept, and I wouldn't recommend it unless you're really a little bit more advanced and a little bit more happy with multiple time frame analysis, because otherwise this can create analysis paralysis and actually be detrimental to your trading. But if you've got some experience in terms of multi-time frame analysis, sometimes just drop down you have your execution time frame, you have your higher time frame for context, but then sometimes once I'm in the trade, I just drop down a time frame to see if there's any danger to the trade from the lower time frames. And you can see here that the Bollinger Bands were not actually that extended, so there was still potential for this to move down. Now, once we got triggered in, I had this area here around 41.05 that could potentially react as a continuation. So I was aware of the potential that this moving average could come down. We could react from that area. So I had an eye on that as a potential danger for the trade. So when I see those sorts of things, I am therefore looking to manage the trade in that area, which means take risk off the table to make sure to mitigate my risk. So the other thing to note as well is from the higher time frame. So we executed on the hourly time frame, but noticed here on the higher time frame, which is a daily, we'd pulled back and we were actually at the dynamic support of the moving averages there as well, with the moving averages just crossing over and starting to point upwards. So this was another confluence factor. So although the market on the higher time frames is in a downtrend and is bearish, we'd actually now moved above the moving averages and we'd pulled back and we'd using it as dynamic support. And as you can see from this zone as well, even on the daily time frame, so on the higher time frame context, those support zones and resistance zones, that zone shows that it's actually a really key, clear area in the market that could potentially show the market to react and reverse from. So we had a lot going for this trade. We had the higher time frame context. It was an area in the market that had been watching for several days, and we therefore got the liquidity grab and the reversal pattern. So it ticked all the boxes, and we exercised the patience all week to wait for the trade that ticked all the criteria, and therefore we were able to take this trade. Okay, so moving back to the execution time frame, we also actually had a zone. If you see here on the 1st of June, we had a zone at 4117 to 4127, and that was the reason that we targeted that 4118 area, because if I just pull up this zone in 4117 to 4127, you'll be able to see here it had acted as resistance over here, and then support here and here on the execution time frame. So and also we had the fact that these moving averages were rolling down, and by the time this moved up, we would therefore then have dynamic resistance in that area of the market that we could potentially react from. So we got 1.5 to 1 risk to reward. It was a key area in the market. The risk to reward was good, but we had the dangers that we had, the relevant dangers that we had spotted in the market for our targets and our management of the trade. So we moved on, and as you can see, the market moved up, triggered us into the trade and started moving nicely. We actually took some half profits and scaled out of this trade around just above 4100 to make sure that the trade was risk-free. And therefore we could leave the trade to run up to its full target at the bottom of this zone, knowing that we couldn't lose on the trade. And as you can see, then the market moved quite quickly into that area of potential resistance. It actually reacted quite nicely from that dynamic resistance that we'd identified as a potential issue for the trade for higher pricing. So we were right to come out of the trade going into the close in this zone here for a nice 1.5 to 1 risk to reward. So this trade worked out really nicely. It had a lot going for it. It ticked all the boxes, and when you have market conditions like this week, where the market is quite quiet and there's low liquidity, it's really important to exercise the patience to wait for that setup that ticks all the boxes, because although they're not going to work every time, they are the highest probability trades, and as you can see, this one worked nicely. So a lot of the time people and traders get chopped in and out of the market, and they lose a lot of money in weeks like this. Whereas it's much better to just wait, be patient. Even if you only get that one trade, there's a good chance it's a winner, and you come out with a nice profit on the week, rather than being chopped in and out and losing quite a bit of money. So hope you found this useful. There's a lot of lessons to be learned in there, but hopefully you can see the advantages of exercising the patience when the market conditions are like they were this week. So I hope you found this useful. I hope you're having a great week, great weekend, and I'll speak to you again next week. Cheers.